don't know why I stopped it, but we're still on section 2, chapter 3, middle of 51. Auto allowance, purchase or lease? Question, should my company buy a vehicle or should I? When should I get an auto allowance? Discussion. First, I'll quote my favorite answer. It depends. There are many options to car ownership. First, your company can buy or lease the vehicle. The company will be subject to the luxury auto rules if the vehicle is under 6,000 GVW and costs more than 15. If this is the case, you're probably better off purchasing the car yourself and receiving an auto allowance. By the way, remember that even if your company leases a vehicle, it still can be subject to the luxury auto rules if your company does buy or lease the vehicle. The company should pay for all gas, oil, repairs, tires, etc. You should calculate the amount of your personal use of the vehicle and report it on your year-end W-2 or 1099. You should calculate the amount of your personal use of the vehicle and report it on your year-end W-2. If your vehicle exceeds, if it's bigger than GVW, your company will be able to take the section 179, $19,000 plus a straight line depreciation over 5 years. In this case, it may be better to take the deduction. It may be more advantageous for you to purchase the vehicle yourself and have the company reimburse you for mileage. It may be more advantageous for you to purchase the vehicle yourself. All right, this is something that's a little confusing. There are many options to car ownership. First, your company can buy or lease the vehicle. The company will be subject to the luxury auto rules, which is if it costs more than $15,500. If it costs more than $15,500, people rev their car because they're really badass. But the company will be subject to the luxury auto rules if the vehicle is under 6,000. So if it's more than 15,500 and under 6,000 pounds gross vehicle weight, then it's considered a luxury. It's considered a luxury auto, and you don't get that deduction. In this case, you're probably better off purchasing the car yourself and receiving an auto allowance. If this is the case, you're probably better off, because if I just get an auto allowance, by the way, remember that even if your company leases a vehicle, it still can be subject to the luxury auto rules. If your company does buy or lease a vehicle, then the company should pay for all gas, oil, repairs, tires, etc. You should calculate the amount of your personal use of the vehicle. But yeah, if it's the company that owns it, I still gotta keep track of everything. And they pay the gas. I don't have to pay it. Of course, like, I'm gonna pay it with the money I have on me, but when taxes come back, I'm gonna deduct that from the company. You should calculate the amount of your personal use. So if it's the company's, then I gotta keep track of my personal use on it. If your vehicle exceeds, if my vehicle is heavier than 6,000 gross vehicle weight and is more expensive, your company will, if your vehicle exceeds, your company will be able to take the section. So if it's my vehicle, it's saying if your vehicle so yeah, they're saying if your vehicle, it's not the company's, if your vehicle, since I bought it, it's my vehicle. If my vehicle exceeds 6,000, it's not considered a luxury auto. If my vehicle exceeds GVW, and it doesn't matter. If my vehicle is over 6,000 gross vehicle weight, it doesn't matter how much it is. So we still get that 24,000. Because if it's underneath 6,000 in weight and above 15,000, that means it's a luxury auto, and it limits the amount you can deduct. So I could take the $24,000 deduction on these items. So that's why they're saying, the company, if I bought it, the company can take the deduction, the $24,000 deduction off of it. Actually, I should be able to, right? Your company will be able to take the section 179, 19,000 plus a straight line depreciation over 5 years. In this case, it may be more advantageous for you to purchase the vehicle yourself and have the company reimburse you for mileage. The current mileage rate at the time of this writing is 36 cents per mile. You may either request reimbursement periodically or have the company reimburse you on a monthly basis at a fixed rate based on your estimated use and allowance. So they could just pay me. You may either request reimbursement periodically or have the company reimburse you on a monthly basis at a fixed rate based on your estimated use. So I could keep track of it and we'll add it up. Remember, I own a corporation, so this is pre-tax, so it's 36 cents that's not being taxed. And you can have the company reimburse you under either accountable or non-accountable plan. I don't know. You can have the company reimburse you under either an accountable or non-accountable plan. I'm not sure. At any rate, keep track of your mileage. I carry an electronic scheduler to note all of my appointments and to-do items. From this listing, I can easily reconstruct the mileage for each appointment or errand. At any rate, keep track of your mileage. I carry an electronic scheduler to note all of my appointments and to-do items. From this listing, I can easily reconstruct the mileage for each appointment or errand. I construct this mileage at the end of the year in case it is ever questioned. So, now for my opinion, I've never seen a lease that makes economic or tax sense. If you're considering that option, weigh your alternatives carefully. Read everything thoroughly and then have a professional read it thoroughly too. If you still think it makes sense, send me a copy and I'll read it thoroughly. Okay, so now for my opinion, I have never seen a lease that makes economic or tax sense. I don't get it. So what is he saying, own? If you are considering that option, weigh your alternatives carefully. Read everything thoroughly and then have a professional read it thoroughly too. If you still think it makes sense, send me a copy and I'll read it thoroughly. A few more points. Commuting expenses between a taxpayer's residence and business location are generally not deductible. There you go. So it would have to be like a meeting. If you have more than one regular place of business, then daily transportation expenses commuting between your residence and a temporary location can be deducted. So I think it's saying, what if I make my at-home a business, right? A few more points. Commuting expenses between a taxpayer's residence. You have to remember, you're separate from a corporation, so a few more points. Commuting expenses between a taxpayer's residence and a business. So I'm considered a tax-paying resident because that's what I live in this place and we have to pay taxes, so I'm a tax-paying resident. So that's what you are. That's our identity in this world, a tax-paying resident. And business location are generally not deductible. So from where I live to my place of business, every day you can't be like, oh, I gotta get. If you have more than one regular place of business, then daily transportation expenses commuting between your residence and a temporary location can be deducted. Meaning like, yeah, because they said the home is a taxpayer's place of business. So, if you have more than one regular place of business, so let's say I do have a home-based business, but I have a fucking shop that I go to all the time. I can't charge for that. Probably won't be a way for me to charge for that. If you have more than one regular place of business, like if you're a plumber and your home-based business is at your house and you go to different locations every day, you could probably charge for that. Tax code C regulation 1.162-1, 1A, special tax deductions. The preceding pages dealt with general business expenses. General business expenses. They are common to most business owners, and tax advisors are generally very familiar with these deductions. Many of these are limited to corporations and so are added bonuses to having a corporation. Many of these are limited to corporations, and so are added bonuses to having a corporation. However, some of them are available to any business owner. With very few exceptions, most business owners and their advisors are not aware of these deductions. I once did a quick case study for a taxpayer and showed him. I did a quick case study for a taxpayer, for a human in America, and showed him what benefits would be available if he incorporated. I included most of the deductions you see on the following pages. He was understandably upset to discover that he had been paying 3 times the amount of tax that he should have been for years. He took the case study to a CPA, whose only comment was that the figures were somehow misleading because some of the deductions would have been available to him without incorporating. In other words, he should have been taking them all along, and there were even more tax savings available through incorporation. That was my entire point. However, you can have she wasn't doing her fucking job. However, you can have a leg up on your advisors. Study the following deductions to see which can be applied to you and learn how to make use of them. I can slow down. I gotta fucking fly through this bitch, you know? I've been reading a lot. My head hurts. It's Thursday. Motherfuckers, when they work, they be lazy. I worked jobs. People are fucking lazy. Have a corporation, you're not worrying about the fucking workers. Your money's safe. You're worried about work. So she's gonna give us an example coming up. She says that about the person. So, or now she's gonna talk about accountable and non-accountable plans, which I want to learn. Let's read this quote. If you think education is expensive, try ignorance. Derek Bach. Derek Bach. D-E-R-E-K. B-O-C. No, B-O-K. Derek, D-E-R-E-K. Space B-O-K. If you think education is expensive, try ignorance. Yeah, so no, because earlier there's like a car. You could tell they probably live in their car. It's like an old a Explorer, like an older Explorer. You know, they're very durable, so they're still around. And it has a trailer in the back. And there was a nice. She was like really young, but she seemed like she might have had a tough life. You know, she has no family or something, so she looks like she's like the passenger in that car over there, where they're sleeping in. And I seen her from far, and she looked really beautiful. I'm like, oh, she's living in there? She probably thinks I'm a weirdo, or who knows? Because like they were looking in these trash cans for bottles, and I should have given them some of my bottles, but I knew a girl like that wasn't alone. She had some guy with her, and I didn't really look at her, but she had a beautiful shape to her. Like she had mad potential, you know. But it looked like she's looking for bottles in the trash can and living in a car with that guy. There's a lot of relationships like that where they bring each other down with drugs and stuff, you know, and she needs protection, you know. And she came like right next, not right, but like right in front of me, kind of like on the other side of the parking lot. You know, they could have been looking for bottles and stuff, but they also could have tried to see who I was, you know, looking for opportunity. But since they're parked right here, I don't know, there's a guy that, where they're parked, there's a guy that lives like in a tent, like in the cut. So maybe they came to visit that guy. Maybe they came to see what's up with me, use the girl to come see what's up with me. But I feel like I'm an asset being here. Like, I feel like a lot more people's shit's getting, like, I want to nobody steal nobody's shit right here. Or even me, my presence has probably avoided shit. Like, as people have seen, oh, I probably just being here every day has stopped some crime. It probably put me in a little bit of danger, but I'm pretty sure like less people have, especially throughout the week, because I'm here all week. So if some people could find some sort of value in that, if they didn't just think about themselves, they might like hook me up or be like, you know. But most people don't know about this tax stuff. So we are on accountable and non-accountable plans. Question: how can I get reimbursement from my company for travel expenses? How do I set up an auto allowance? Discussion: a business can provide for either accountable or non-accountable plans for the employees. An accountable plan is a reimbursement or expense allowance arrangement under which employees must substantiate the covered expenses to employers and return any excess amounts received. There are 3 criteria to meet to satisfy the accountable plan requirements: business connections, substantiation, return of amounts exceeding expenses. So, accountable plan. So you have to be accountable for what you spent it on. A business can provide for either accountable or non-accountable plans for the employee. An accountable plan is a reimbursement. Accountable plan. Accountable. You have to be accountable. You have to show proof. Plan is a reimbursement or expense allowance. Reimbursement or expense allowance arrangement under which employees must substantiate the covered expenses to employers and return any excess amounts received. There are 3 criteria to meet to satisfy the accountable plan requirements: the connections to the business, why, substantiation, has to make sense, return of amounts exceeding expenses. If your plan does not have all 3 of the above criteria, then it is a non-accountable plan. Amounts paid to an employee under a non-accountable plan are reported on the employee's year-end W-2 form. Amounts paid under an accountable plan are not reported anywhere. An accountable plan may provide for an allowance for meals, incidental expenses, and mileage allowances. One important point: a greater than 10% owner in a corporation one important point. An owner who has more than 10% in a corporation is not allowed to take a per diem rate for meals. You may receive an expense allowance, but you must substantiate all expenditures and return any excess. I don't get it. I need an example. You may receive an expense allowance, but you must substantiate all expenditures and return any excess. In practical terms, you would first estimate approximately how much incidental expenses, mileage allowance, and meal allowance would be reasonable for a given period. This amount is paid to you each month. Then on a periodic basis, at least annually, you would substantiate the total amount paid with a mileage log, expense reports, and receipts. So I have to have an accountable plan, and the reason why the company's paying me this is because I feel like that covers a lot of stuff though, because if how much incidental expenses, mileage allowance, and meal allowance. So you're gonna have to estimate it. Incidental expenses like gas, maybe, I don't know, accidents, like a blown out tire, lost time. And then you have to pay that to you each month. And on a periodic basis, at least annually, you substantiate, you give proof, the total amount paid, you know, with the mileage log, expense reports, and receipts. Following is a summary of requirements for a non-accountable and accountable plan. Type of reimbursement: accountable expenses, employer accountable expenses and reimbursements are equal. Employee reports on Form W-2 not shown. So, okay, so then it makes sense. So, accounts expenses, so I don't have to put it on a W-2. I can just get a deductible for that. Accounts and reimbursements are equal. Accountable expenses and reimbursements are equal. Not shown on W-2. And then reimbursements exceed expenses. If the corporation pays the employee, pays him back too much than what he spent, he needs to show in the excess. The employee, the individual, the taxpayer, has to show it on the W-2. Expenses exceed reimbursements. You paid more than was got back. The corporation paid more than what was. So the corporation reimburses to the employee more. So the employee has to show that they got extra money. But if the corporation spends more, it gives back. If the corporation spends more and reimburses or less to the employee, it's not shown on the W-2. Non-accountable. So what's non-accountable? Okay, so if your plan does not have all three of the above criteria, business connections, substantiation, return of amounts exceeding expenses, return of amounts exceeding expenses, accountable expenses and reimbursement are equal. Okay, so accountable expenses and reimbursements are equal. So whatever you spent on business connections, and you have proof of what you spent, and you return, and the return of amounts exceeding expenses, does it mean you made money back from it? How do I get this deduction? Determine if you are going to use a non-accountable or accountable plan. Although it is more work, you get more deductions with an accountable plan. Adopt a formal plan. Keep track of your expenses and periodically turn in your expense report to the company. Tax code. See section 62C and REV space PROC 95-50. Achievement awards. Question: how can I create a deduction for the corporation that is not taxable to me? How can I create a deduction for the corporation? How can I create a deduction for the corporation? How can I create a deduction for the corporation that is not taxable to me? Deduction with no resulting income? Discussion. One of the many items available for your business is an achievement award in general. An employee achievement award is an item of personal property that is awarded to an employee as a presentation for length of service or safety achievement. In general, an employee achievement award is an item of personal property that is awarded to an employee as a presentation for strength of service and safety achievement. There are two kinds of awards that a company can make which are deductible for the corporation and tax-free to the individual. These two are non-qualified plan and the qualified plan. These two are the non-qualified plan and the qualified plan. Non-qualified plan. An award valued up to $400 per year can be made. There are no specific guidelines. Just give yourself an award for doing a good job. Qualified plan. A qualified plan does require additional work but offers a larger deduction. First, it must have a written plan that does not discriminate in favor of highly compensated employees as to eligibility or benefit. First, it must have a written plan that does not discriminate in favor of highly compensated employees as to eligibility or benefit. A length of service award will not qualify if it is received during the employee's first 5 years of service or if the employee has received a length of service award during the year or within the last 4 years. An award will not be considered a safety achievement award if made to a manager, administrator, clerical employee, or other professional employee, or if during the tax year awards of safety achievements previously have been made to more than 10% of the employees, excluding managers, administrators, clerical employees, or other professional employees. Up to $1,600 can be given under a qualified plan. Tax tip: if you are the president and manager of your company, consider awarding your employed family members under a qualified plan. You can receive the non-qualified plan award. Okay, what? If you are president and manager of your company, consider awarding your employed family members under a qualified plan. You can receive the non-qualified plan award. How do I get this deduction? You will need to draw up a written plan in order to use the qualified plan deduction. You will need to draw up a written plan in order to use the qualified plan deduction. Regardless of which plan you use, always document the award in your minutes with the reason why the award was given. In honor of going 1 year with only one paper cut, the corporation awards you a set of $400 golf clubs. As always, track your expenses with a good accounting system and save your receipts. It seems like you're just turning that gift into cash back to you, you know? Tax code: see code 274J2, code section 274J3A, code section 274J3B, and code section 274J4. Business gifts. What kind of gifts can I deduct? Does the recipient have to declare it as income? Discussion: you're allowed to give business gifts up to a value of $75 per recipient per year. What is a gift? As with most deductions, first find a business purpose. Maybe you want to foster some goodwill with your employees, your vendors, or your next door neighbor. These could all qualify as business gifts. Items that are clearly of advertising nature, such as an embossed coffee mug or pen and pencil, aren't counted in the total. These could all qualify as business gifts. Items that are clearly of advertising nature are not business gifts. You can exclude signs, display racks, or other promotional materials given for use on business premises. How do I get this deduction? As always, keep track of the expenditure with a good accounting system. Additionally, make a notation maybe on the invoice as to whom the recipient was and maybe a few words as to why there is a business purpose. For example, let's say you give turkeys away for Thanksgiving. On the receipt from the grocery store, make a notation that you gave a turkey to each of your employees and your neighbor who collects UPS packages for you when you are gone. On receipt from the grocery store, make a notation that you give a turkey to each of your employees and your neighbor who collects UPS packages for you when you are gone. I wonder if you're like a YouTuber or somebody, like who's your employee. Also, since the cost of one turkey is probably less than $75, you can also buy a ham for Christmas for each of them. Just keep the total under $75 per recipient per year. Tax code: C code section 274B1 and REV Proc 9550. Giving is the business of the rich. J.W. Gautier. Giving is the business of the rich. Cafeteria plans. How can I get a full deduction for daycare? How can I deduct the full amount of my term? How can I deduct the full amount of my term life insurance? Discussion. A cafeteria plan is probably the answer to many of your questions. More and more employers are adding cafeteria plans. The secret they know is that cafeteria plans are easy to set up, cost little or nothing to administer, and provide a savings from payroll taxes. A cafeteria plan is an employer-sponsored benefit package that offers employees a choice between taking cash or receiving qualified benefits. A predetermined amount is withheld before taxes from an employee's paycheck. A predetermined amount is withheld before taxes from an employee's paycheck that can then be used by the employee for qualified benefits. These qualified benefits include daycare for the children or adults, group term life insurance, medical insurance, and medical expenses. The reason that many employers like these is that the amount withheld for cafeteria plans is not subject to any payroll taxes, either by the employee or the employer. Usually your medical insurance carrier will provide a cafeteria plan for you, free of charge. Employees love the plans because they can deduct the full cost of items such as medical insurance or daycare when these deductions are usually limited on their Form 1040. Employees love the plan, so employees love when employers have a cafeteria plan for them. Because it's not in any payroll taxes. There's no payroll taxes. So even the employer or the employee loves the plans because they can deduct the full cost of the items such as medical insurance or daycare when these deductions are usually limited on their Form 1040. There are certain items that are specifically excluded, such as scholarships, education assistance, and specific excludable fringe benefits. Yeah, daycare is different, but if they're giving you money, you can't deduct that. Or educational assistance can't deduct that. Okay. See codes sex 117, 127, and 132 for further information, or discuss this with your insurance carrier. They're called cafeteria plans. So it's these qualified benefits include daycare for children or adults, group term, some life insurance, daycare, medical insurance, medical expenses. It's called cafeteria plan. It's like all for like you being a human and your kids, your medical insurance. But that's what the corporation offers for the employees. Giving is a business of how do I get this deduction? You must have a written plan and there are reporting requirements. Your best bet is to see your insurance agent and use one of the standard plans available. Reflect the adoption of the plan in your corporate minutes. The withholding is done out of employee checks. Prior to any tax withheld. Tax code. See code section 125, proposed regulation 1.125-1, code sections 117, 127, and 132. Dependent care. How can my corporation pay for my dependent care? Your company can pay up to $5,000 in dependent care services. $2,500 if you're married, filing separately. Amounts over these limits are taxable to you. Meaning me as an individual. So if I need more, then I have to be taxed. To qualify for this benefit, the dependent must be under 13 years old, physically or mentally incapable of caring for himself or herself, a spouse who is physically or mentally incapable of self-care. In addition, you can't discriminate as to who gets this benefit. In other words, if your corporation has 2 employees, then both must have this benefit. There are some additional requirements discussed in the following section. Note that you cannot take this deduction if the dependent is aged 13 or over. If this is true for you, consider the cafeteria plan. I think right there we're talking about a corporation. Oh no, I'm talking about this is an employee, right? Employee. So what is a dependent care? Your company can pay up to $5,000 in dependent care services. That's annually? I'm assuming, right? Because it's taxes, so it has to be annually. The dependent must be blah, blah, blah. How do I get this deduction? First, you must have a written plan. Additionally, the employee benefiting from the exclusion must report the taxpayer's identification number of the provider. Additionally, the employee benefiting from the exclusion must report the taxpayer's identification number of the provider. Get the identification number before you give the provider anything. I have found that it can be impossible to get someone's social security number after the fact. Finally, have a good accounting system to track expenses. First, you must have a written plan. The employee benefiting from the exclusion must report the taxpayer's identification number of the provider. Get the identification number before you give the provider anything. The taxpayer's identification number. Dividends received deduction. So you need the taxpayer's identification number of the provider. Tax code, see code sections 129 and 21B1. Dividends received deduction. Question: I've heard that I can reduce the amount of taxes I pay on dividends received by having my corporation receive dividends. How does this work? Dividends received deduction. I have heard that I can reduce the amount of taxes I pay on dividends received by having my corporation receive dividends. So you can reduce the amount of taxes you pay on dividends by having your corporation receive dividends. How does it work? Discussion. A corporation can take a special deduction from gross income for dividends. A corporation can take special deduction from gross income for dividends received for domestic corporations. No. A corporation can take a special deduction from gross income. A corporation can take a special deduction from gross income for dividends received from domestic corporations that are subject to income tax. This deduction is 70% of dividends received from a corporation owned less than 20% by the recipient. So if I just have a few stocks in it or something, 70% of dividends received. So I get 70% back. 70% of dividends received from a corporation. $80% of dividends received for a 20% owned corporation, or 100% of qualifying dividends received from a member of the same affiliated group. So if I own more than 20%, I get 80. 80% of dividends received for a 20% owned corporation. 70% of dividends received from a corporation owned less than 20% by the recipient of the 70% of dividends, right? If a corporation owns stock in corporations that are completely unrelated to your company, then you pay tax on only 30% of the amount of dividends received. If a corporation owns 20% to 80% of the stock of the company, if your corporation owns 20 to 80% of the stock of the company, then you pay tax on 20% of the amount of dividends you receive. If your corporation is part of an affiliated group, i.e., 80% or more, 80% or more of common ownership, then you do not pay tax on any of the dividends received. There are some special rules for foreign corporations that vary and are based on specific circumstances. If you have a concern, see Code Section 245A and B and talk to a tax professional. In total, your company cannot take a deduction of more than 70% of its taxable income without regard to any net operating loss. In total, your company cannot take a deduction of more than 70% of its taxable income without regard to any net operating loss. Dividends received deduction. Capital loss carried back. capital loss, carryback, or adjustment for non-tax portions of extraordinary dividends received. You are not allowed a dividends received deduction for stock held by your corporation for 45 days or less. You are not allowed a dividends received deduction for stock held by your corporation for 45 days or less. If the stock is cumulative, what does it say? If the stock is cumulative preferred stock, it must be held at least 91 days to qualify for the deduction. Further, the dividends received deduction is reduced by dividends. Further, the dividends received deduction is reduced by dividends received from debt finance portfolio stock by a percentage related to the amount of debt incurred to purchase a stock. Not sure. Finally, make sure that you don't fall into the personal holding corporation definition. Finally, make sure that you don't fall into the personal holding corporation definition. How do I get this deduction? This deduction is simply taken at the time that you file your tax return. Make sure your tax preparer is aware. This deduction is simply taken at the time that you file your tax return. Make sure your tax preparer is aware of this seldom used corporate advantage. Why is it seldom used? Shouldn't it be more than that? See Code Sections 243, 246C, 246A, and Regular Section 1.243-2. Education assistance. Well, let's read this. We all have possibilities we don't know about. We can do things we don't even dream we can do. Dale Carnegie. Education system. Question: how can I deduct the cost of my advanced degree? A corporation can pay up to $5,250 per year per employee for tuition, fees, books, supplies, etc., and the employee can exclude it from his or her income. Further, the exclusion is available for both undergraduate and graduate degree programs and applies even if the employee is not seeking a degree. The courses covered by the plan need not even be job-related and could be courses involving sports, games, or hobbies if they involve the employer's business or required as a part of a degree program. Any excess greater than $5,250 would it be included in the employee's gross income and be subject to payroll taxes and federal income tax. How do I get this deduction? You must have a written plan, retain records, who took what course, and a brief description of the course, and file an informational return for the plan. Adopt the plan in your corporate minutes, and what a surprise, track the expense with a good accounting system. Tax Code. See Code Section 127 and 6039D and Regulation Section 1.127-1. Group Term Life Insurance. Question: can my corporation pay for my life insurance premiums? Your corporation can provide $50,000 worth of term life insurance per employee. Any excess more than that is added to the employee's income based on a table showing the cost per 1,000 of insurance. Your corporation can provide $50,000 worth of term life insurance per employee. Any excess more than that amount is added to the employee's income based on a table showing the cost per 1,000 of insurance. The current table is available through your insurance agent. Any excess more than that is added to the employee's income based on a table showing the cost per insurance. The current table is available through your insurance agent. The amounts that must be included are generally minimal. It is important to note that you can't discriminate against any employee of the company with regard to this benefit. How do I get this deduction? See your insurance agent for a term insurance policy. Reflect the approval of the purchase of life insurance for employees in the corporate minutes, and keep track of the expenditure with a good accounting system. Tax Code. See Code Section 79 Regulation sections 1.79-1 to 1.79-3. Health insurance. Can my corporation pay for my health and accident insurance? Health insurance is fully deductible for your corporation, as long as your plan does not discriminate against employees. Note that there are special requirements and restrictions for the amount of deductibility of insurance if your business is anything other than a C corporation. How do I get this deduction? See your insurance agent for a health plan, and simply keep track of the expenses with a good accounting system. Medical expenses. Can my corporation pay for preventative health care items, such as vitamins or weight loss programs? Discussion. Corporations can deduct 100% on many medical expenditures if the corporation authorizes them. How do I get this deduction? Adopt a resolution to implement a medical reimbursement plan that covers all your preventative and ongoing healthcare needs. You just have to see how much you're spending on it. Adopt a resolution to implement a medical reimbursement plan. So you have to pretty much say that you paid it back. This is non-discriminatory and must be offered to all employees. I can only get from that, it says, because the question is, can my corporation pay for preventative healthcare items such as vitamins or weight loss? Corporations, yes, so adopt the resolution. How much you're putting into it. You're not making no money off it, but you are getting a deduction from it. Alright, so I'm going to take a little break. We're not even done with this section yet, but we have about 10 pages, and then we'll be done with section 2. Peace.